Here is going to be our framework for trading GME going into this next week. We know that the June OPEX is coming up, and there should be a pretty massive run. All obligations are leading us to believe this. Different video, but we're going to actually go over what our exact plan is. And first off, we'll start with me. My plan is to open this up in tranches. And today, June 14th, I started my first tranche because I don't know what's going to happen for the rest of the week. If the market starts going up, GME could catch a bid. We don't know if there's going to be early obligations being filled. We could have even seen some of that today. But we do know that next week, there should be a pretty big run. So today, I first started to put in my first position. My goals are different than everyone else's. So this is strictly for my goals, and my goals is the absolute maximum leverage as humanly possible. Like literally as humanly possible, I am trying to put in as much leverage as a human can get, and you do that by going as far out as out of the money. And my first tranche, this is going to be the majority of my position. So today I opened up some BBBY positions. So first I'll show you what I did with BBBY. BBBY is almost a leverage play on GME because if GME runs, there's a high probability that BBBY does too after this OPEX, and the options are very, very cheap. And since my goal is maximum profits, today I picked up some contracts. I got them for 13 cents. I picked up about 30 of them, but I plan on doing more and more of that throughout the rest of the week. I also picked up some GME 950s today, but I'm going to continuously and ever expand my positions throughout the rest of the week. I plan on getting, I don't know, anywhere from a few thousand BBBY contracts and as many GME contracts as humanly possible, mainly through the 950s. This is going to be my first tranche, the vast majority of my position, the most risky. I mean, anyone that is new to options to stay as far away from this as humanly possible, because when you go extremely far out of the money, the opportunistic time to sell these, the window is very, very small because you're betting on implied volatility going up. You make all the gains from these IV spikes. I'll just take you and show you kind of this BBBY. If we do see, since I'm betting on IV, if we see a massive IV jump because BBBY goes up $10, $20, and right now it's $6, but let's say it goes up to 20 this cycle, that is going to be like a 6,000% increase because the IV is jumping so drastically. But you will only have minutes to sell that. So the majority of my position is going to be out of the money as far as humanly possible. So I like the Januaries on GME because you can go out to 950, and I'm trying to buy anything under $3. I will pay more if I have to, but ideally I want to get them under $3. And if they do get under 3, I'm going to be buying them pretty much every like 20 minutes. Every 20, 30 minutes I'll be picking up contracts because you want to average in and get the best price possible. My second tranche is going to be probably the July 15th 200 calls. This is going to be much safer because they'll have a lot higher deltas. You're going to be paying a lot more for them, but what you do have is a lot more safety. So if we do see a quarterly run up, just the small safer position that I'll be holding. The reason why this is going to be a much smaller position for me, even though they're much safer, is because they cost so much more. And my goal is maximum leverage. So this is great for someone who's getting new into options. That would probably be what I'd be looking at. But since I plan on selling next week, no matter what, because if we don't see this run up next week, therefore my theory and from what we can see, these obligations it is not from what I can track. Therefore, I am wrong, and I'm going to be selling by next Friday if nothing happens, no matter what. So I'm going to be eating very little theta decay on the majority of my positions going out towards those January 950s. And I mean, like maybe I'm down, I don't know, 10, 15, 20% if nothing happens. But if we do see a run and we see $100 to $200 run, it's not going to be a 10, 20% increase. It's going to be like a 1,500 to like 6,000% increase just because implied volatility will be through the roof because the stock's running so much from such a low period. Justin, what is your main plan going into this next week, structuring your option positions?
Gotcha, Josh. So taking a page from your plan, which is basically what it sounds to me is like a pure volatility play. So tremendous, amount of upside, but also a tremendous amount of risk. And again, I can't, emphasize this enough. Options are dangerous. If you don't know what you're doing, you probably shouldn't be messing with them. Anyways, that said, I myself have it already established. So I've had a pretty hefty buildup of GME 950 calls, and that's kind of how I hedged, or I guess you would say how I've managed my violent upside exposure to MOAS. And also, I kind of have built myself into having that IV play as well. So I feel like I've already got a pretty decent position established there. I think I've got a few outstanding limit orders that haven't yet filled for more 950 contracts. My attitude on that front is that GME, as of right now, is 125 the market's about to close. Let's say GME closes today at 126 or whatever, right? And let's say it drops back down to 110 tomorrow. Well, if my 950s fill, okay, yeah, and if GME drops by 10-20%, yeah, there'll be some shaving off the contract, but there's not a lot of intrinsic value on those 950s because again of the you're pretty much just banking on volatility and against theta for those. So anyways, I already have those established. I then think that I will probably do maybe 3 tranches. And there's probably a better way and a more sophisticated way of doing that, of which I do not yet know. And this shows my lack of experience in this world. But I would probably start picking up no later than Friday, but probably on Thursday, at the money calls. So there'd be like one tranche would be at the money calls. Whatever GME is trading at, that's what I would buy. Then I would also buy another tranche. October or January. I haven't made up my mind yet, but my attitude is this. I mean,
do you plan on like if you're buying those at the monies, are you just trading them for the cycle? Therefore, why would you go out so far?
The reason is because I'm incredibly inexperienced in this. If I had the experience and the technical ability to parse the data and read it together, I'd be much more confident with a shorter play. But my thinking is that I don't know when this is going to happen, and this is kind of the real estate guy in me talking. Like it does, and which is probably what you do not want to do if you're trading. But I do not mind sitting in a position. Like I just don't mind that. And if I'm going to do that, then I probably don't want to have or probably managing theta, so you have far dated contracts. Managing a theta decay by buying far dated contracts is maybe one way you would want to help ameliorate that problem. But either way, let's just say you go with October or January or whatever, right? I would kind of think of 3 tranches. So you have like an at the money, then like a kind of out of the money, and then like a kind of even more out of the money position.
What would be the majority of your position? Would you go at the money, out of the money, or farther out the money?
I would probably put the majority up to like 50%, probably close to at the money.
At the money.
So right now, remember, I already have my volatility position established. So when I talk about buying, I'm talking only about entering new positions because I already have that big ass, other position.
I'm talking about strictly for this cycle.
Okay, yeah. So the way I'm going to answer this question is like of the new contracts that I am planning on buying, probably 50% of what I would spend would be located to at the money. And the reason, and this is the nuance with that, if you're buying at the money calls, you want to buy those, unlike buying a deep out of the money call or whatever, right? If you buy an at the money call today, GME goes down by 20 or 10 or 20% or whatever, right? You've lost a lot of value of that call versus buying a deep out of the money. So I kind of want to bide my time and be coy. Josh, I'd rather enter late if GME's running up for an at the money call than buy early just to have GME go back down. I mean, obviously, I'd like to snipe the bottom just to be clear, but if wishes were fishes, you could catch them in the sea. So whatever. So I'd probably do that. Then I kind of do like a midpoint and then like a high point, and this is in addition to that big volatility play that I've got too. And honestly, Josh, what I'd like to do, if I can time this right, is I would like to, and I don't know the answer to this one, but cash settle options that generates enough capital for me to actually start exercising options. So what I really would like to do is, let's say volatility spikes up, and let's say I sell just numbers on my backside, 50% of my volatility position or whatever, right? So I still have some exposure for maybe another cycle or mini run or whatever, right? But I've gotten all of my cost basis back, and then I have a little extra cash to play around with. I would then probably take that and start exercising my deepest in the money calls to get shares, and then I would really seriously consider writing covered calls once I thought we were getting close to the peak. Now, again, this is assuming that we think it's going to come back down. This is assuming you don't have some runaway event or whatever. So again, this is all subject to interpretation, but generally, that's kind of the logic.
Yeah, right now, all we can tell is that this is just going to be like a regular cycle. Therefore, you have to plan accordingly. That does not mean you don't still have a preparation in case MOAS does happen, because I think it will be pretty obvious if things start to get out of hand. And if we still, let's say we go into next week and it is running, but we don't see any fizzle movement. And in fact, we see everything suggests that more people are piling in and FOMO is actually getting surreal. Maybe GME goes on Reg Show and super stonks coming in, all Reddits. If we start to see the call option volume, I wouldn't just sell just because we were running. If there's all the data that suggests that the run would continue, and let's say some other stuff happens, the market starts tanking in correlation with it, then you could be just in a greater position for MOAS. But since we don't know if it will be MOAS or not, but we do think this cycle will happen just because it looks like there's a bunch of obligations that are due. If they do roll them, this is something else that I see. I see 2 real situations. One, what I do think, my base case, is that we will see a cycle, and I'm planning extremely accordingly, putting on a humongous position size. But two, what if they do dodge these obligations and they roll them like they did in one of the previous cycles, I believe February? That would just make the compounding effect of the next cycle even greater. So I would think it is in their best interest to kind of just get rid of these obligations now. But if they don't, then I think the probability of an even bigger cycle the next time is just vastly greater.
Yeah, Josh, so here's my comments on that front. When I look around and I look at the market mechanics and all this, like again, like, huge hat tip to PyFi. By all means, subscribe to him and watch him if you're not already doing that. But I look at him, and this guy spent, I don't know how many years, decades, studying this stuff. And you can even see when he's like, oh, that's interesting. We never thought about it like that. If you have an expert like that who can still be thrown, a curveball, like when I look at myself, and I don't consider myself to be a fool, but nor do I consider myself to be, by stretch of imagination, a pro. I look around and I say, like, there's a lot I get, there's a lot that I don't know. And so the way I kind of, deal with that, like internally, is, by time, by theta, and just kind of see what happens and react accordingly. But I definitely like the idea of having, no pun intended, optionality. And so if I want to sit in a call for a period of time, I can. If I want to close out, well, again, I can do that too. And hopefully, there hasn't been that much time decay on it or whatever. But I think that's a really important thing to note, is that the people on the other side of this trade, these people are not fools. They're very smart, they're very connected, and they're very wealthy. And they have a lot to lose, more than you and I.
The last tranche, I went over the first two, which was going to be the extremely out of the money, the vast majority of my position. Then the second tranche was the slightly out of the money, around the 2 to 300 strike range. The third will just be a very small amount of at the money calls. The reason for that is just because that's the safest. That'll be probably my first to go, but I'm going to sell everything accordingly. That is, if possible, I would exercise them if we do see a humongous volatility play and the 950s are just spiraling out of control, and if we do see a MOS style event, or if this cycle is just much bigger, because so many shares are being DRS, the volatility on GME is increased greatly, and that provides even greater opportunities for these cycles. It is just the perfect storm if you're an IB trader.
Yeah, Josh, one of the things just to note too, and this is one of these like emergent properties that I don't know what's going to play out going forward, but retail got pretty this is my personal guess, so just please take this as just my own opinion, verbal diarrhea. Retail got pretty burned in November when the option cycle didn't play out the way retail was banking on it. And so retail, I think, really got soured on options. Since then, it seems that the sentiment's kind of come back. And so the reason I mention this is that if you do have retail FOMOing into options, but doing it in a way that they have slightly more elevated risk management, or they can do so in a slightly more intelligent manner, that's really yeah, less retarded. There we go. Less retarded. If they can do so in a less retarded manner, that's actually really interesting, because if retail actually learns like how to start making money, not like, I'm not talking about like, Wall Street decades, but I'm just talking about like they're able to make enough, then you have more interest in options. You have less people getting burned, God willing, and that's going to be an interesting setup. Like I don't know if we've actually been in a situation like this before, where retail feels confident enough to play options and win.
It's not just going to be retail. I personally have told a lot of big money about this upcoming cycle, since we have so much data. I mean, people that we used to manage way too much money for our like Citadel type amounts of money, and if I'm making sure that they have their eyes on it. They all laugh at me when I even mention this. One called me very childish and naive, and which is okay, because I am. But if this does happen, I can assure you they will give me props, and they will probably ask what the mechanics behind it were, just because everyone just says that was a great trade. And the thing that it would spark curiosity within themselves. And I can assure you this will happen to more and more people if we continuously have these cycle run-ups. And it's almost an infinite money glitch if this does happen and it continues to happen. So why would you ever want it to stop? How are you guys playing this upcoming GME cycle? Let us know in the comments below. Thanks.